Welcome back to the Daily Crypto Roundup, your quick but powerful look at everything that matters in crypto right now. If you're new here, make sure you hit follow so you never miss the next episode, because the pace of this market is only getting faster. And if you've been with us for a while, you already know what we do here. We break down the headlines, the moves, and the meaning behind them. Today's stories are massive. We're talking about BlackRock's ETF dominance and why it's rewriting the rules of institutional investing. We've got the S&P launching its first digital markets 50 index and pulling crypto right into the heart of traditional finance. India's finance minister is officially talking about making the country stablecoin ready. A new meme token called Giggle has gone absolutely ballistic, surging nearly 400% in a week. And the old-school Debasement Trade is back, driving billions into Bitcoin, gold, and silver as the dollar wobbles. Plus, we'll end with where the market goes from here, the next catalysts that could move prices through the weekend. Let's start with the numbers. Bitcoin is trading at roughly $122,736, up about 0.7% in the last 24 hours. Ethereum is sitting at $4,467, down about 1%. Solana is holding steady around $222, down roughly 1% as well. XRP is $2.87, down around 1%. Cardano's at 82 cents, off 1.5%. Avalanche is $28.33, slipping just over 1%. Dogecoin's holding 25 cents, up nearly 1%. Tron sits at 33.7 cents, barely down 0.1%. Chainlink is at $22.07, slightly lower on the day. And Litecoin rounds out the top 10 at $117, up almost 1%. The market's calm, but the undercurrent is shifting. Traders are clearly positioning for what's next. And that brings us straight to BlackRock, because no one, and I mean no one, is moving the market like they are. BlackRock's Bitcoin ETF just crossed the $135 billion mark, capturing nearly 60% of all assets held across every crypto ETF combined. Let that sink in. One company controlling almost 2/3 of the ETF capital flowing into Bitcoin. Bloomberg's Eric Balchunas compared it to gold's first ETF boom, saying, "It starts as a trickle, then it becomes a flood." That's exactly what we're seeing. Over the past 30 days, daily inflows have averaged around $290 million, with more than half of that going directly into BlackRock's fund. It's not just Bitcoin, it's changing institutional psychology. CoinShares head of research James Butterfill said this week, "We've moved from whether institutions will own crypto to how they'll own it." And that shift is seismic. Fidelity, ARK Invest, and VanEck are all playing catch-up, trying to replicate BlackRock's structure. Tighter spreads, better custody, full transparency. What's really fascinating here is how this ETF dominance changes the market's DNA. Instead of whales driving price spikes through exchanges, you now have pension funds, insurers, and endowments averaging into Bitcoin through a regulated, trackable product. It's cleaner, more stable, and ironically, more bullish long-term. According to Coinmetrics data, institutional accumulation is now at its highest level since early 2021. The only difference is that this time, it's not speculation, it's allocation. This is long-term money, not fast money. The moment ETFs started taking flows away from the spot exchanges, Bitcoin became an asset class that Wall Street can't ignore. But while the ETF story dominates headlines, another quiet revolution is happening in traditional finance, and it might be even more important. The S&P Dow Jones Indices just launched its first ever digital markets 50 index. And while that may sound like a mouthful, here's what it really means. Crypto just got its own version of the Nasdaq 100. This new index tracks the top 50 digital assets alongside a handful of publicly traded companies tied to blockchain innovation. It's designed to measure how digital assets move relative to equities, something no major index provider has ever dared to do before. Peter Rothman, S&P's global head of innovation, said, "Investors need transparent benchmarks. This is the bridge between digital assets and traditional markets. That single move tells you everything about where finance is heading." For years, Wall Street looked at crypto from the outside. Now it's being coded directly into its indices. When you can benchmark performance, you can build products. When you can build products, you can allocate capital. It's the same playbook that turned the Nasdaq from a tech curiosity into a trillion-dollar benchmark. Analysts at ARK Invest called the new index a recognition that digital assets are here to stay. And they're right, because once the S&P starts tracking something, it's no longer speculative. It's official. Meanwhile, halfway around the world, India just sent a signal that could reshape how digital money moves through one of the biggest economies on Earth. Finance Minister Nirmala Sitharaman said this week that India must be stablecoin ready. That's a big statement for a government that, only a few years ago, was threatening to ban private cryptocurrencies outright. What she means by stablecoin ready is that the Reserve Bank of India wants to prepare its payment systems, especially the UPI network, to handle regulated digital currencies. It's a smart move. India already processes more than $1 trillion a year in remittances. If even a fraction of that flow starts using stablecoins on a regulated track, transaction costs could fall by 60 to 80%. Economists in Mumbai are calling it a digital remittance revolution. Anjali Bhargava, a senior economist at ICICI Bank, said, "If India connects its domestic payment rails to tokenized assets, it could lead Asia in settlement speed." That's not an exaggeration. India's UPI system already clears billions of transactions per month instantly. Combine that with stablecoins, and you've got the first real link between the fiat world and blockchain liquidity at scale. And this isn't some distant dream. The RBI is already testing limited pilot integrations with fintech partners. It's one of the clearest examples of what regulatory progress actually looks like in practice. Cautious, but forward. Now, not everything in the market is about institutions or central banks. Some of it is pure chaos, and that's exactly where our next story comes in. This week, a meme coin called Giggle went absolutely parabolic, jumping more than 380% in just 4 days. The project, launched through Binance's nonprofit foundation, markets itself around positivity and laughter, but the price action has been anything but lighthearted. Trading volumes crossed $500 million in 24 hours, and social media mentions exploded. Analysts are split. Some say this kind of mania means we're near a local top. Others say it's proof that retail energy is coming back into the market. Austin Arnold from Altcoin Daily summed it up perfectly. When meme coins move, it's not about fundamentals. It's about emotion. It means people care again. Historically, that's been true. Meme coin rallies have always signaled retail re-entry, often before the big institutional moves follow. Giggle's wild run is a reminder that beneath all the ETF news and regulation debates, crypto is still about community energy. Unpredictable, sometimes ridiculous, but undeniably powerful. Before we go any further, a quick reminder: before you make your next move, make sure your crypto is safe. Grab a Ledger hardware wallet using the link in the description below. It's the simplest and most secure way to protect your coins before volatility hits. Because if there's one thing we know about this market, it's that the unexpected can happen fast. And speaking of volatility, let's talk about the macro story driving everything right now, the so-called debasement trade. It's a term you're going to hear more of in the coming weeks. Inflation pressure is creeping higher, the US debt load is at record levels, and Treasury yields have started to wobble. Investors are once again seeking safety in hard assets, and this time, Bitcoin is moving right alongside gold and silver. Bloomberg's commodities team reported that combined inflows into Bitcoin and gold ETFs jumped 20% over the last month, marking their strongest quarter since 2021. Gold just crossed $4,000 per ounce. Silver is rising fast, and even with this minor crypto pullback, Bitcoin remains up over 40% for the year. Michael Novogratz from Galaxy Digital said, "People don't believe you can print trillions forever without consequence. Bitcoin is the modern hedge against that disbelief. You can see it in the data. Bitcoin's correlation to gold has surged back toward post-pandemic highs. This is exactly what Bitcoin was built for, to act as an insurance policy when the financial system starts to creak. But here's what's different this time. In 2020, the debasement trade was mostly retail fear, individuals fleeing inflation. Now it's institutional strategy. Major funds are rotating 2 to 3% of portfolios into hard assets, not to make a quick buck, but to protect purchasing power. That's why BlackRock's ETF success is such a big deal. It's the on-ramp for this macro shift. Bitcoin isn't just an asset anymore. It's part of a new monetary defense system. We're also watching macro data, particularly next week's CPI print in the US. If inflation runs hotter than expected, it could add more momentum to the debasement trade and bring new inflows into both Bitcoin and gold ETFs. On the flip side, a cooler report could bring short-term relief for equities and take some pressure off crypto volatility. Either way, liquidity is back in the market, and for traders, that's what matters most. Zooming out, this week's theme is clear: integration. BlackRock and the S&P are tying crypto deeper into the traditional system. India is preparing its financial infrastructure for tokenized money. Retail energy is roaring back through meme coins. And the old macro narrative, that crypto thrives when fiat confidence fades, is back in the spotlight. This isn't the kind of market that's about to roll over. It's one that's quietly maturing. Every bull cycle needs structure, and between ETFs, indices, and regulation, we're watching that structure being built in real time. It's not as flashy as the early days, but it's far more sustainable. Institutions are here. Retail is back. Regulators are talking instead of banning. The crypto market is no longer asking for permission. It's just continuing to grow. And that's where we'll leave it for today. The week ahead looks packed. New ETF flow data dropping on Monday, Ethereum's upgrade approaching, and more central bank meetings that could shake the macro picture again. Keep your notifications on because we'll be breaking it all down right here tomorrow. Drop your thoughts in the comments, hit follow, and as always, we'll see you at the top.